Really looking forward to this conversation. And Luke, it's interesting. I know when the Bloomberg Live team dreamed up this conversation, we thought it'd be dominated by inflation. And here we are. It's the banking crisis, as we just heard, that's taken center stage. And Francine and John teed us up really perfectly, because I actually want to start where they left off as to whether this crisis is over yet. What do you think?
So no would be my answer. Sorry, John, if he's left.
Okay, perfect. Panel over.
Yeah, exactly. But again, depending what you define by crisis, I think that we will have a significant number of more banks that will not exist 12, 24 months from now that exist today. Which ones will be taken over? Which ones will have a shotgun marriage as we had at the weekend? Which ones will disappear of their own accord? That's a question. Clearly, the central banks and regulators are trying to stop things disappearing of their own accord, but the shotgun wedding is all with us. I came in this morning and the headline was, it's all great at First Republic. The shares are up 30% yesterday. It's all over. And you're like, the miracle of compounding is just to remind everybody. So it was up 30% yesterday. Yay. But that means that it was, as opposed to being down 90%, it's now down 87%. Right? 30% when you're down 90% is really nothing.
Is that where the risk is when you say that some banks might not exist? Is that where you're looking toward these more American regional banks? Or is it another Credit Suisse type bank that, at least at one point, was one of the most systematically important?
So it definitely applies to smaller. So whether it's regional banks in the US, it's challenger banks in the UK, it's, in the end, what this has all reminded us is in the modern world where everybody's got a phone in their pocket, and if they want to move all their money from A to B, you can do it while listening to me, and you probably won't even miss anything I say in the time it takes you to move all your money from bank A to bank B. What that means is that at any time of stress, people are going to move their money to one of the banks that they think the government is behind. And that means the deposit base of any of the smaller banks becomes flighty. And the moment you've got, banking doesn't work if you haven't got a stable deposit base, as we've just seen. And they are naturally less stable now.
I think this is a really interesting point, because not even just with mobile banking, but technology also allows us to tweet any concern we have about the bank. For VC founders to tweet saying they're advising all their companies to pull out money from a bank. Does this show us what crises will look like from now on, given the technology-enabled nature of them?
So yes, things happen at a much faster speed. Whether that's a crisis or it's good news that information travels much faster. And so, look, we had a run on a bank with no newspaper headlines, because it happened before the newspapers had even got there, with no queues around the bank. That's how the modern world works, and it throws certain parts of the banking system into question, and therefore regulation's got to respond to it, and it sort of means the big, highly regulated banks, where they are too big to fail, become the place everybody's going to have an account open that they can move their cash to at the last minute. It means smaller banks are going to have to pay higher returns on deposits, and that then means they're in, they haven't got a critical advantage.
Right. How are you thinking about how that translates to the wider economic environment? Mike Wilson over at Morgan Stanley thinks that there could be a credit event. The latest Bank of America fund manager survey also says that a systematic credit event is now the highest risk over inflation. To you, what is the biggest risk?
So I think there's a causal link in there. So we still have very significant inflation. The UK just showed it's not going down monotonically.
Still double digits?
It's still double digits. That is scary. The US still has an inflation problem, and particularly when you look at wage inflation in the services industry, while that is 6, 7, 8%, you're not going to get back down to 2% inflation. The Fed, it was really sort of easy to forget Powell's presentation to the Senate 2 weeks ago. With everything, what he was saying is we have to push harder, and effectively we have to break something, right? In order to get inflation down in the US, I'm afraid that if they want to get it back to 2%, they have to have more people looking for work than there are jobs available. You know, at the moment that ratio is the other way around. One, you've got that, then yes, you've got the sort of negotiating power is in the employees, and so you get wage inflation. If you want to get inflation, anyway, so they sort of have to break some stuff. I mean, this bit when people say, yeah, we're going to get rid of inflation without breaking anything, we're not going to increase unemployment, we're not going to, like, something's going to break.
Right.
And, you know, we're seeing part of it is in the banking system where people got into the wrong position. It will, so I think it's a sort of, you start with, if you want to get rid of inflation, then they have to keep rates high enough to cause pain, and that will break things. Something at the boundary will break, and then you have to deal with it.
What do you make of the argument that, and you alluded to this, something has broken, now the Fed can stop, other central banks can stop?
In a difficult way of saying it, not enough has broken. Look, I mean, Credit Suisse is big news because it's a brand name that we all know throughout our career type of thing, even, you know, but the reality is Credit Suisse has been, I don't know, I'm not sure whether shooting itself in the foot is a polite expression anymore, but, you know, they've been sort of working their way up both legs with a gun for the last 5 or 6 years. You know, I mean, like it's a constant thing. And so it was inevitable that, you know, Credit Suisse wasn't going to survive. And it happened that, you know, it's this last squeeze is what did it, with a sort of demonstration of a sort of run on deposits. But, you know, that one is relatively unique. While the problems are in smaller banks, whether it's regional, whether it's local, sort of, it isn't an existential risk to the system. You know, look, if we get to, you know, pick your favorite, but I mean, Bank of America is the one with the biggest unrealized losses in their hold to maturity box. You know, I mean, I don't think there's a problem there. I don't think there will be a problem there. But that's the, you know, if we end up there, then we know we're in a real crisis.
In terms of that, it has been a period we've seen over the last week of assets that are considered risk-free or close to risk-free have been the demise of SVB. AT1s in Switzerland, more risky than perhaps most people had thought, given that they've been zeroed out.
I got to say,
yes,
you know, the one rule of investing in credit is you've got to read the document, right? And it said in the Credit Suisse AT1 documents, I mean, it said what would happen. The Swiss government wasn't pretending. The rules are different in Switzerland than they are in the UK, or they are in France, or they are in the US. The US banks don't use this stuff as much, but the one rule in credit investing, and this is, you know, to that question that sort of might, you know, will a systemic credit event cause the problem? You know, I don't think we've seen the lows in equities for this cycle. Personally, I think we have a big sell-off somewhere in our near future. I mean, I don't mean this week, but I mean, you know, coming. Could it be caused by credit? Will it be caused by earnings first? Don't know. I mean, you have to see how it develops. But people who, you know, if you invest in a bond or you lend money to someone and you don't read the document, you deserve whatever happens to you.
But is it not a symptom of the zero rate environment, that people were taking more risks and paying less attention to them? Are there more shoes to drop?
Yeah, I mean, look, yes, people got used to I mean, for 10 years, there was effectively no credit risk in the world because it's quite hard to go bust as a company when you can borrow money at zero forever, right? I mean, it's like you have to work really quite hard to make a mess of that because money was free. You know, there was no reason to have a diversified portfolio. You know, this is about strategies for wealth creation. For 10 years, diversification was stupid, right? You wanted the most concentrated portfolio you can have. There was no point in risk management. If it went down, you just bought more. And that was the right strategy for the 2010s, all the way up until, you know, we got to 2022. But once inflation is out and in the system, as it now is, I would say it's exactly the wrong strategy. And so in a pivoting from, you know, there's a lot of people still sticking with, yeah, but, you know, I just buy every dip in equities and hopefully it'll work out. But I don't think it will for the next 5, 10 years while we have an inflationary period. Diversification really helps in that type of thing. Risk management really helps. And, I think you want a completely different portfolio. Obviously, you did in 2022, but I would say you do for the next, I would guess this is the rest of the decade type of thing.
Have you seen that change in what's in demand at Man Group too?
So our client base is institutional and they move at the speed of their organization structure. So you can see the change happening gradually, but it doesn't happen overnight. The things they're asking about today are different than they would ask about 12 or 18 months ago. There's just a time, it takes an institution years, not weeks, to put their portfolio where they might want it for the future, which is one of the challenges.
Right. And it does feel as though we've been lurching from crisis to crisis in this market environment. How have your conversations with clients changed as crises take different shapes in very different ways? But again, that concern is still there.
Well, look, I think the bit is every client essentially came into 2022 with a max long equities, whatever the rules were, the maximum amount they could be long equity, they were long it, maximum long private markets, assuming that government bonds were their hedge if they needed it, but their government bond position was smaller than it had ever been. One of the bits of that is whatever they told me in 2015 max long equities was, the max long was now bigger, right? So they'd all done that thing where it was working, so we'll increase the limit. And obviously that was exactly the wrong portfolio to have in 2022. And so they come into 2023 and go, okay, how do I think about the right amount of equity beta to have in the portfolio? How do I think about how much private risk is okay? Am I getting paid for the illiquidity? Because the point is you're supposed to get a premium return for it. And you would think people would like government bonds more at 4%. If they like them at 0, you must like them a lot at 4. The reality is when they own them at 0, they thought there was no downside. Maybe you could lose 1 or 2% in my bond portfolio, but that's it. Now they look and go, okay, it's a 15 to 20% downside in bonds. That means people aren't suddenly increasing their bonds. So I would say clients are trying to figure out what to do. I sort of obviously think liquid alternatives are a good answer to the problem. And, I think enough clients are moving in that direction that the next few years should be a very good time for flows into the hedge fund business. I would say that, wouldn't I? But the point is what people want is something which is liquid, which made them money last year, which, that's sort of, it's a pretty short list.
Yeah. I mean, to that point, all of the AHL systematic strategies posted positive returns last year, which is not a lot, is something most hedge funds can't say. But systematic strategies, a lot of that underneath there is trend following. How does trend following work when the trend at this moment is just pure volatility? Treasury yields up one day, up 20 basis points, down 20 the next day.
So the systems adapt. Look, I mean, I've got to say, and you can see it on our website, we were positioned with Powell, the systems were positioned with Powell, and so, when the first sell-off in rates came, that wasn't good for us, but that's what happens with systems. The bit though is they adapt, certainly ours, adapt very quickly to changes in volatility. So with the volatility you've got now, we run much, much, much smaller positions than when markets are calm. I think that's a rational. You want to take a certain amount of risk when markets are highly volatile. It needs less notional to take the same amount of risk. When they're less volatile, you can afford to take more. So, we would naturally run lower positions, and you can therefore adapt to the market changes quickly.
What do you think is the most successful environment for these types of strategies? Last year was obviously it. What made it successful? How does that get recreated?
For anything that's about alpha, right? Whether it's trend, whether it's stock picking, it's in the end, the amount of alpha you can generate is the product of the skill you've got multiplied by the opportunity set. And the opportunity set is best thought of as dispersion. If everything goes in the same direction at the same time, it's impossible to add value through selection, right? So, it's sort of simple to think of it in the long-short equity world, because everybody can think of, if all stocks go up and down together, there is no opportunity, however much skill you've got, there's no opportunity to add alpha by being long one and short the other. The more dispersion there is in outcomes for shares and sort of by definition but for companies, the more opportunity there is for stock picking alpha. The same is true in the macro strategies, the top-down strategies. If all markets go up and down together, it's not good for us. The more dispersion there is, the better. Our skill is positive in every market, but it's small in a single market. You need the dispersion across hundreds of markets to get the high skill. And, so sort of the best, we've tried over time to build a model for dispersion, to predict dispersion. We haven't been able to. I don't know anybody who has. But a heuristic to think that inflation creates economic uncertainty and economic uncertainty creates dispersion is a pretty sensible heuristic. And, so last year was very good, but actually we've been making money for the previous 10 years, even though the environment wasn't good for us.
Right.
I feel like we're going into a world which creates a lot of alpha opportunity if you've got skill. There's you have to have that skill bit, because if you have lots of dispersion and you're long the wrong thing and short the wrong thing, just means you lose a lot of money.
Right.
So.
And while we're on this topic, we do have an audience question, which feel free to send them in as we're here in the final minutes. Someone's asking about algorithmic trading. Are there opportunities to leverage systematic trading and AI to find investment opportunities?
So we've been using machine learning. I always slightly worry about the word artificial intelligence because, it's a mathematical process. You can decide whether you think that is or isn't intelligence. I'm not sure it's the bit that we credit as intelligence, but we've been using machine learning techniques for 6 or 7 years. And they're good at some things in investing and they're not very good at other things. The reason the ChatGPT stuff gets so much coverage is that the place where machine learning is really effective is to consume all of the words that are out there. So take all the research reports produced by the banks. It is millions of pages of stuff, and it's sort of impossible for humans to read all of that. And machine learning techniques can read it very quickly. And so for consuming words and summarizing them or giving you nuggets of information, machine learning is very good, and we use it very actively for that. If, on the other hand, you chuck a whole load of market prices at a machine learning process, the nature of machine learning, the question of why I put inverted commas around the I in artificial intelligence, it always thinks there's an answer. So if you throw a load of market data, a machine learning technique will always find a pattern that means it wants to take a position. The reality is the vast majority of market data is noise, doesn't have information in it. And it's really hard to get machine learning techniques to be parsimonious about when they trade, when they don't trade.
And just a minute to go here, Luke, but how good is it in spotting crises? And I ask this because we have a question saying, could AI spot issues in banks like SVB in the future?
So as I say, I think it's very good for getting through words. It's an interesting. I don't know. You needed. Look, I'm not a regional bank investor, so not my specialist subject. But I would say I don't think you needed an AI to spot a potential issue in SVB. I think any time you see something anywhere in finance where their growth rate is unrelated to the market growth rate, you want to worry. You can take market share in percentage points. You can do better or worse. But if you look at the deposit base of SVB, it grew at a rate that is unlike anything going on in the rest of the banking system. Finance is too competitive a business to have something that's an outlier like that. right? And so anytime you see an outlier, as opposed to thinking, in a real tech business, you can get things that are outliers and compounders, right? I mean, Bloomberg's a great example. I think it's, probably the most successful fintech business there's ever been, right? And it's a compounding advantage. But in banking, I mean, there are how many thousand regional banks there are in the US. To have one that's suddenly doing a profile that's completely different than the others, it's more likely to be a problem than it is that they've invented some completely new way of doing banking.
Right. My takeaway from this is always read the documents.
Always read the documents. It really is a good answer.
Luke, thank you so much. Everyone, please join me in thanking Luke Ellis, Man Group CEO.
Thanks very much.